Hello, welcome back to the channel. A huge announcement from the Fed just triggered massive reaction from millions of Americans and people worldwide. Recently, the Federal Reserve Chairman Jerome Powell announced that the Fed will be tapering, slowing down, reducing the purchase of assets. Now, what does this have to do with anything? Remember, in 2020, during the pandemic era, we did see a policy that was employed by the Fed to go out there and buy the bonds, mortgage-backed securities and assets to help the economy. Now, this is something that will be slowing down and eventually will be cut off depending on how things are going according to the Fed. So why is this a big deal? It is a big deal, but why is it a big deal? We got to talk about it in today's video. So let's talk about this right now. The reason why this is a big deal is because this affects you and me, and this is something that you gotta care about. So be sure to watch till the very end of this video to avoid missing out on any of this important information. You know, there's multiple channels out there talking about this. There are multiple media outlets. You know, the report is huge, but I've done my best to compile and digest this, synthesize this, break this down, you know, in such a way that you will understand and I will understand exactly what's going on with this move from the Fed. So the very first thing, like I said, is that this is a big deal for you and me because inflation is the reason behind all of this, right? The price of goods and services has been on the steady increase. The Fed likes to see inflation at right around 2%, and currently the rate of inflation is more than double that number. It's been hovering around 4 to 5%, and that's huge compared to what the Fed wants to see. And you know, this is impacting a lot of things. But during this announcement, right, the Fed has attributed this move as being transitory. You know, so basically the Fed has said that this inflation is transitory. It's caused by the delay of production and the delay we've seen in supply chain. So that's what we're seeing from the Fed. So the very key things that I want you to understand when you're going through this, in your mind, you got to be thinking about what the Fed is cutting off. So what exactly will the Fed be tapering? Like I did say earlier, the Fed was buying all these assets, and that some of the assets that will be impacted include treasuries and MBS, mortgage-backed securities, and other securities, bonds. This is something that you got to pay close attention to, especially if you are an investor. And even if you are not an investor, you got to also pay close attention to this. So these are some of the key assets that the Fed will be tapering off. So the Fed will be slowing down on purchasing these assets by billions of dollars every month. So how much exactly is expected? According to the report, the Fed is expected to cut down on treasury bond purchases by $10 billion a month. So right now, the current amount of the current volume is $80 billion a month. So the Fed is purchasing $80 billion a month. And the reason for this purchase, like I said earlier, maybe I haven't mentioned this, the reason for this purchase from the Fed is to help the economy, to increase the price of goods, and you know, to basically make sure that things you know, keep things at a higher price and lower interest rate. This was some of, you know, one of the original moves that the Fed made in 2020, and right now we're going to see a slowdown by $10 billion. This might not seem like a lot, but it is huge. Stay with me. And also, we're seeing from the announcement from Jerome Powell, there's going to be a $5 billion a month decrease in purchases made when it comes to MBS, mortgage-backed securities. So this basically means the Fed purchasing mortgages, you know, debt, mortgage debt that people, you know, your mortgage, my mortgage, you know, mortgage-backed securities. And this is basically what we're going to see, $5 billion. Currently, this number stands at $40 billion a month purchased by the Fed. So every month we're seeing $40 billion. That's $480 billion a year that the Fed has been purchasing since the pandemic. So some of the other key things that you got to understand right now with this move is the goal. So what exactly is the goal? Like I said, if you've been picking up some of the information I've been dropping, you understand that the big thing here is inflation. So the key things that I believe is driving this move from the Fed, based off of the news from the announcement from Jerome Powell, the Fed chairman, is he did make an indication of or are stronger labor market. So he wants to see a stronger labor market. He wants to see employment pick back up. And he also wants to see price stability. You know, prices have been insane. I mean, cost of used cars to commodities, everything has been on the increase. So he does he does want to see price stability. That's something that he's indicated that he wants to see. So these are the two main goals, in my opinion, that's driving this move. Now, the real question is, how could this possibly impact you? What impacts will you see in your pocket? How will this impact your bank account? How will this affect your financial condition? How will this impact your family's financial wellness? That's what we're going to talk about here real quick. So the first thing that you got to understand is there's a potential that this move could lead to a rise in interest rates. Even though Jerome Powell has said that there are no intentions to immediately raise the interest rates, and that's not what he's going for. But this is basically, in my opinion, going to raise interest rates. And that's what some economic experts have indicated. So interest rates, now, is this a good or bad thing? Let's talk about the bad side of this before we talk about the good, right? So some of the impacts or the downsides of that increased interest rates is that the cost of borrowing will increase. So whenever you have an interest rate that goes up, that means that your mortgage rates will go higher. The loan on your car payment, if you're going out there to get a new car, will increase. You're likely going to see, interest rates increase for the average consumer debt. So this is a possible scenario that we could see. As a result of this, you're going to feel that in your pocket and your bank account. And the next thing that we're going to see with this is, when it comes to the interest rates, will be an economic decline. When the cost of borrowing goes up, normally, people will retract and not spend as much. Companies won't spend as much because borrowing goes up, because most companies, they take on debt to expand their businesses. So we're likely going to see some type of economic decline if this really impacts interest rates, if this move from the Fed impacts interest rates. And the other thing that we could possibly see, we've talked about the economic decline, but the other thing that we could possibly see will be a correction in the market. There could be a market pullback as a result of this. So if you have some exposure or have some position in the stock market or the capital markets, you gotta care about this, right? Because there could be a correction coming with this stuff next year. Now, we don't know exactly what will happen. No one has a crystal ball, but these are the possible scenarios you have to prepare yourself for. So now that we've talked about the downsides, now there still has to be a good side, right? The good thing about all of this is, if this leads to a lower interest rate and an increase in interest rate, right, we're likely going to see home prices soften. So home prices will likely go down. Maybe, I'm not talking about a crash. That's not what I'm talking about. I'm just basically saying, explaining the relationship between interest rates and home prices. Typically, when the interest rate is higher, you see home prices, not shoot up like what we've seen in the past few months. But when the interest rate goes low, asset prices, home prices intend to go up, because again, it all goes back to the cost of borrowing. The cost of borrowing, becomes so cheap, money becomes so cheap that anyone can easily get access to it. Or maybe that's not the right word, but it's more accessible and it's more affordable. That's the word. It's more affordable to people. And when that's affordable, you're likely going to see a lot of people competing to purchase assets. So one of the things, the good things that we could see from this move from the Fed will be to lower the prices of homes. Remember, inflation, we talked about that. That's the goal. It's price stability. So this is a good thing that could come out of this, and this will impact your pocket. For those of you who are looking to, get into a new home, especially millennials, this is something to keep in mind. Okay, so now that you know the impacts, how this could impact you or how this could affect you, how exactly could you prepare yourself for this? In the next few months, we may not see anything happen, but by 2022, chances are that the impact of this will be real. This move right now that we're seeing will be real in 2022. Right now, it's still imminent. right? But it will become real next year. So the one thing that I'm doing right now, I mean, I'm not necessarily going to tell you what to do. I'm just going to tell you what I'm doing, or what I plan on doing. So what I plan on doing to prepare myself for this is what we call or what experts call the defensive investment strategy. So that's what I'm employing. I am employing a defensive investment strategy. So what exactly does this mean? This means that I'm going to conservatively manage and allocate my investment. So in order to the goal here, you know, the goal of this defensive investment strategy is to minimize the risk of, you know, my money going to zero or losing money as a whole, right? So that's just the plan. That's how I'm preparing myself, and I think you could use some of that too if you choose to. Of course, you got to talk to your financial advisor and talk to your the financial experts in your life. But exactly this stuff that I just said right now is what I'm doing. So let me know your thoughts about this. Do you think this will impact you? Do you think this will be a big deal to you? Is this even a big deal to you? Let me know your thoughts in the comment section below. Again, if you've enjoyed this video, you know, thank you for watching. I want to see you in the next video. Stay safe and hang around. Be great.